Hold on for one. Thank you, everyone, for following the directions to the new link. You're in the right place. We'll get started in another minute. Okay, I think we can get going here. Thank you for joining me for deconstructing the myths about the payment facilitator model. Everyone is on mute, but I'd encourage you to please type a question in the chat or Q&A fields, and we will cover those questions near the end. I'm going to be rolling along, and just something comes to mind that doesn't make sense, or you want to expand on it, feel free to put a comment in that chat window or the Q&A. All right. I'm Ted Vanderberg, Vice President of Revenue Operations at Infinicep. I've been here about 3 years. And my role includes solution consulting, so helping our prospects and clients understand all the details of what it takes to become a payment facilitator and use our platform. Before that, I spent a long time in the payments industry, and it can be complex. So this is definitely not a beginner payments kind of approach. This is for a software company that or payments company that really wants to take their capabilities to the next level and do it the best, most modern way. So the agenda, why are software companies embedding payments? That's a key word, kind of a buzzword, embedding payments. I'll talk a little more about that. Becoming a payment facilitator, the benefits, the myths, the requirements, the costs, a financial model overview, just so everyone understands, the big driver behind being a Payfac. Some real client examples and alternative options, things that have emerged in the industry. I'll explain that. And then finish off with the foundation for embedded finance solutions, which is really growing in popularity as well. And we'll have time for that Q&A at the end, for sure. And we are recording this, so that will be available. That was our first question. Oh, no need to furiously take notes or screenshot things like that. We will make this recording available. So the first thing on the agenda, why are software companies embedding payments? This term is different than the word integrated payments. Integrated payments have been around as long as software has existed, because any kind of website or software that needed to take payments had to integrate with a payment provider, with a processor. And that integrating for payment processing is still required. But embedding payments means something a little bit different. These software platforms, or anything that is helping a business operate, any kind of a vertical software, maybe they're helping schedule appointments, maybe they're helping manage customers. Adding payments goes along with your other product functionality as a key part of the value you provide. But it goes beyond just integrating and having that payment capability. We have to look at the whole life cycle of your customer. How do they onboard to get that payment processing capability? If you're in a referral model where you just send your client, your software client, over to a payment provider, maybe give them an 800 number, maybe give them a link to a website somewhere, it is going out of your control, and you don't know what kind of experience they're having. So this is what we mean by embedded payments, is if the entire end-to-end experience with your customer you are controlling and helping them get signed up for payment processing. You need to collect some data to run some underwriting, and you need to onboard them to a processor. That happens behind the scenes. You keep control of the customer experience. And then you provide that processing capability, and you provide the customer support. So you're in control of that entire end-to-end experience. You settle the funds to them and provide them that information. So that's really what we're talking about with embedded payments, and the payment facilitator model is the best way to offer that to your clients. Everyone needs software to run their business. Everyone needs to take payments as part of that software. So this is why it's such a growing model out in the industry. So the first benefit, creating a better product. If you are referring your payments to a third-party company, you're creating a disjointed experience. The product might include, it includes taking a credit card number, great, but everything leading up to that is disjointed. So you can offer a better solution, a better product, keep people in your ecosystem, in your software, have them work with you to set up and manage that entire payment program, just like they do with the rest of your software. Take control. That's the other big reason people become payment facilitators, is they want the control and the ownership. You set the fees. You decide the funding details. You make the onboarding decision. It's not just whether you're following compliance rules. You're making a decision on taking the risk of providing payments to that customer. So you should do some underwriting and check out the business. And then you make the decision because you know them better than anyone else. They're your customer. And then you own the data. When you're a payment facilitator, one key indicator of that, it's your name on the merchant agreement. You can combine that with your other your software agreements. You can combine it with the rest of your solution. You are the payment provider as a Payfac. And so it's your name with their name on that merchant processing agreement. That means you have control, ownership. You can take that revenue and you can use any gateway, any processor. It's up to you. So these are the main reasons why people become payment facilitators. That higher revenue and valuation, we'll go over that in more detail of how to calculate that. But basically, you get to claim the full transaction discount fee. So that payment transaction fee is your revenue. You're not just taking a rev share from someone else. You're claiming that entire transaction fee as your revenue. And that helps a lot in business valuations down the road. If you're looking in the future, if it's on your contract, you own that revenue as part of the business deal. It can be a problem if it's someone else's revenue that doesn't really count for your business. So look at the long-term situation here of why you want control and ownership of that revenue, that data, that client experience. Now, there's a lot of people that are very invested in keeping you from becoming a payment facilitator, namely all the payments companies out there that have been providing this to people all these years and making money. They see this as a threat. When the ISO, a salesperson, used to go to the local dry cleaners and the little restaurant and sell their terminal, well, now that restaurant, a dry cleaner and hardware store, they're not buying that terminal, that standalone terminal device from a retail ISO. They're getting it through their software. And so that's a threat. That threat, it's killing the ISOs. It's killing that model because it's better experience for everyone to get payments through their software. So these people have a lot of reason, the entrenched payments industry have a lot of reason to dissuade you from becoming a payment facilitator. So the first thing that you'll see out there and hear people talk about costs over $1 million. It's so expensive. In fact, it's not. There's virtually no capital expenditure required to become a payment facilitator. Solutions like Infinacep give you all of the functionality you need to onboard clients and manage their fees and funding without building that software yourself. So really, that is not true. It doesn't cost over $1 million. You have to hire a huge team. That's also not true. We have many of our clients just have one additional headcount to run the payments program. So that is not a huge team. The larger you grow, you're going to want to add more people to manage the different components. Customer support is usually handled by your existing team. Product development, any kind of new ways you want to present capabilities, that's part of your product roadmap. But it's separately just for adding payments, doesn't really require a huge investment in more people. Takes over a year to set up. That is also not true. Most of our clients go live in 3 to 5 months. There are a couple big efforts involved here to get the benefits of being a payment facilitator is you get to work directly with a payment processor. That oftentimes is a new relationship for people. They need to have a processing agreement and have to integrate to a payment gateway. Now, a lot of times, if you're using a third-party gateway already, they can direct those transactions to any large processor. But that's one piece, is you have to have that processor relationship and agreement in place. And we help clients with that. The other thing is you need to have policies and procedures. This is how Visa and MasterCard, Amex Discover have allowed companies to use this payment facilitator model. They do that because you are required to follow certain rules. And we outline those in a series of documents called policies and procedures. And this is guidance for your team running this payment program to say, these are the kinds of merchants that we're going to onboard, we're going to approve. And this is how we're going to know they're good operators. We're going to follow these steps. If this comes up, this is how we're going to handle it. If there are large transactions that are outside of these parameters, this is what we're going to do to investigate. So as long as you follow these policies and procedures, you're compliant. So those are the two main things, is getting a processor agreement, having policies and procedures, which Infinicept has been doing for years for over 250 companies. So we really know how to do this and customize them for your particular business. Those are the main components that go into that, but not years. You don't have to build everything from scratch. Utilize someone who has done this over and over again, and then you have control of the program. The other fear that's out there, people talk about risk, right? This is anyone who's afraid of the new solution out there and is afraid of losing business. They like to use fear as a tactic. Oh, you don't want to take on liability for payments. That could put you under. That's not true. Unless you're in a high risk kind of vertical, most of our clients are typical businesses and their losses are below 1 basis point. So ask yourself that question. If someone some payment company you're working with is earning 30, 40, 50 basis points because they're taking the liability, the risk of the transactions, maybe you're overpaying for insurance, right? If your losses would be 1 basis point, why are you paying someone 30 basis points to take that risk? It's usually not there. And then the final thing, compliance. I mentioned that before. We provide the needed knowledge and tools to easily meet compliance. It's not as scary as some people make it seem. First of all, you have to follow your sponsor bank and card brand policies and procedures. You just follow those instructions of how you manage the program operationally with the right tools and looking for that, having the tools that alert you to anomalies and things that might be wrong. And then the second piece of compliance is PCI compliance. And that is the technology you have to have that protects the card data to make sure that hackers don't steal that card data. And that is very easily handled by the gateway you use, where they will tokenize and encrypt the data to make sure it's secure. So that's compliance. I just explained it in like 15 seconds. It's not hard to manage compliance. So those are some of the risks or the myths. And now let's talk about what you have to have. You need to have a viable business plan and financials to support the operations and potential chargebacks. So if you're going to be approved by a sponsored bank, which you have to have a bank do this, and you need a processor, you need to be able to show them that you're capable and that you have a legitimate business, that you have good customers, that you're going to be a solid, reliable partner. That is a requirement. And so it may be hard for a brand new company, brand new business that doesn't have a lot of operational experience. And it will definitely be hard for anyone who is thinking of being a payment facilitator because you want to skirt the rules and try to do things that are not upfront and in the open, because nobody really wants to allow that, to give you that control to do nefarious things. So you have to have a good business plan. We help our clients put together their entire approval package of financials, policies, and procedures, all the details that you need to support being approved. And the sponsor banks and processors love it when an Infinicep client comes in. They've told us this, that it's kind of gets it on the fast track for approval, because they know that everything is in order. They know that we're helping our client provide all the stuff that they need to review and that they need to approve their business. So part of that, policies and procedures, I explain that, how you're going to manage risk and compliance. You need to have that sponsor bank and processor approval, and you do need a payment gateway and processor integration. So Infinicep is not a gateway. We are not a processor. We're not giving, we're not this all-in-one platform to plug into that does everything. We are an enabler of your payment program, and we want you to have all the options out there now and in the future. And that includes how you're going to integrate to a gateway and a processor, because there's a lot of key functionality that those companies deliver, and there are thousands of gateways out there. In any of these kinds of technical questions about payment processing of, okay, so do you do card on file? Can we do Apple Pay and Google Pay? Can we do these kinds of, can we have this kind of terminal or that kind of terminal? That's all driven by the gateway. That's all driven by that partner. And that's why we don't think you should get locked into one processor and one gateway, because it's going to limit your options for whatever comes up next that you want as part of your payment functionality. So that's why that we help our clients choose the right gateway. That's part of our process. Help them choose and match them to the right processor for them. But we give you the choice. We give you the ownership of that. And the primary operating expenses for a Payfac program. First of all, you need the technology to manage your sub-merchants. So there's a lot of data involved with the payment processing, and that has to be sorted and organized and presented to the sub-merchants. This is something that is a key value of the Infinicep platform, is we package that and provide that all for your sub-merchants, either a white label solution or API. So that's all available, but we've done that hard work of coding to the processors, integrating into their back office processing platforms and into their onboarding platforms, which is kind of hard to do. It's not like integrating to a payment gateway. There's very little documentation and support. So we've done that heavy lift already, and so you can just focus on the customer experience, presenting them that data, not figuring out how to calculate interchange plus and provide these different fees and funding schedules and make that all work. We've done that, the technology part. And we do that as software as a service. We don't charge transaction fees. We charge a monthly platform fee. We want you to be the payments company and not get in the way of the rates and how you want to charge your clients. So that is an operating expense, is you have to have this platform. The second thing, program setup costs with the sponsor. So your biggest cost actually is going to be the buy rate of the transactions. That will be something that you negotiate and work with the sponsor or processor on. And then The compliance policies and procedures. So that's part of our launch fee, part of our setup fee is that we will build these custom policies and procedures for you. And then staffing, one or more FTEs to manage this program. A lot of our clients start out with one. I'd say every few hundred million in volume or thousands of merchants per month would necessitate adding another headcount. So it doesn't scale real quickly, but the larger your opportunity here for payments, obviously, the more resources you're going to need to support that program. Generally, these operating expenses, these costs, I'll say, do not scale anywhere near the revenue from payments. So by owning the full payment revenue, it's going to far exceed how these costs, either for our platform or the processing buy rate, staffing, all of those things go up less gradual as your top line revenue will. So let's talk about that next. Let's talk about some of the financials. So the financial model, top line revenue, this is the transaction fee. It's also called the discount rate, multiplied by your payment volume. So we'll give an example of that, but this is the top line revenue you can count as your revenue if you're taking that risk and setting the fees to your merchants. Then the largest cost of payments, which can be controlled in a few different ways, usually by managing your data correctly and having the right technology, like the right gateway that is being secure and doing things in the most secure way that will help with your interchange. This is the biggest cost of a payment program. It's the fee that the issuing bank charges and the networks charge for running that transaction and settling it across their network. More expensive cards, like corporate cards, rewards cards, they're going to have higher interchange. You can't necessarily control that. It's what the consumer brings and is using to pay. So this is a big part of the cost. We can model that out. You can plan for it, and you can do some things to reduce what that is by managing your data correctly. So you take out the interchange fees and assessments, that gives you net revenue. And this is another place where you have the option as a payment facilitator to recognize as your revenue if margins are the biggest concern. So you can claim this top line revenue. However, there's a big chunk that comes out as interchange, and that's gonna show a fairly small margin, profit margin. So the other option you have is to recognize net revenue as your top line. So this is something to talk about with the CFO and your accounting team. And then the final thing deducted from that net revenue are the operating costs specific to the payments program. So that would be like the Infinicep monthly fees. That would be maybe headcount dedicated to the payment program. And then that leaves you with the profit or your EBIT. So that's how you're going to calculate the benefit of owning these payments. And I'll give you this example here. Let's say you have 100 million in payment volume. So you're selling $100 million worth of stuff, service or product, and you charge 3% transaction fee, just to keep the numbers round and simple here. So your top line gross revenue is $3 million, 3% of 100 million. Now we take out 2 million for interchange and network fees. So let's say it's 2%. That's your cost of goods, and that leaves you with 1 million in net revenue. Then from that we take out, let's say, $150,000 a year in software costs and $150,000 for that headcount, salary and benefits. That leaves you with $700,000 in profit or EBIT. These are the kinds of numbers that we like to look at and make sure the clients understand. There are so many different ways that payments companies will position their pricing. We'll give you this rate and this rev share, and it's really important to understand whoever you're talking with about payments. If they say you get a rev share, it's a rev share of what? Like what we get a 40% of what? And it's often very murky, and that's a problem if you don't understand and can't outline exactly what you're getting a revenue share of. So consider that. This is just a generic example using big numbers. Your industry may be different, your particular market. We know of some companies that charge much more than 3%, and they use convenience fees to pass that on to the cardholder or the buyer. We know some that bundle their software costs into this. So they say, we're going to charge a certain amount, and that includes our software. Or you could charge less than this and charge a higher monthly fee. There's so many different ways to do this, and it's in your control. You're the one that gets to set this pricing. However you want to do it, with a mix of percentages, cents, interchange plus. That what we're not doing is we're not hiding things. We want this to be nice and open and transparent so you can make the right financial decision here. So I'll go through a couple of examples here, a few examples of some real clients and their actual data from our platform. This first example with their name disguised, Mobile Meals, they had 380 million in payment volume, 60 sub-merchants, and added one person to the team to run the program, and it took them 120 days to launch. So the math here, their top line revenue was 11.4 million. So that's whatever fees they're charging for that volume. Interchange was this 7.7 million. That leaves them net revenue of 3.7 million. Operating expenses, Infinicep cost, that headcount cost, 281,000, left them with 3.4 million in profit. This is way more than they got from a rev share agreement. Way more than they got when someone else was making the money on their payment program. This is their software, their program. They took ownership and control of it, and now they're getting this money. They cut out the middleman. Next example, dentist dollars. So another vertical software company, 700 million in payment volume, a little bigger, 1,500 sub-merchants, 2 people to manage that. And 65 days to launch. This actually was an example that this real short time frame was accelerated because they had been working with another provider, and it went south. And so they asked if we could jump in and finish the project and get it across the finish line. And that's exactly what we did. So now they have 21 million in top line revenue, 14 million of interchange and fees taken out from the networks. Leaves them with 6.8 in net revenue, operating expenses 475, a little higher, right? Because they've got 2 people, more volume there, and then that gives 6.3 million in profit. So very scalable. You can see the next example, of course, costs went up just a small amount, right? We're looking at the difference, 21 million top line revenue and 475 in operating expenses versus 54 million top line revenue, and the expenses only went up $200,000. So this is the key benefit of owning this, is as your volume goes up, your revenue is going to scale much faster. So this is a bigger client, 1.8 billion in revenue. And actually just to mention, at this level, when you're at $1 billion or 2 billion, that's when our clients really start to look at diversifying their processor and adding another one. That helps them negotiate their rates. It helps them not have all their eggs in one basket. And you can't do that if you are locked into someone else's payment program. If your merchant agreements are have the name of that other company, the payment company, you can't move those merchants until you either pay some kind of a cancellation fee or the contract comes to term. But in a Payfac program, the contracts are in your name with your merchant. So you could decide, okay, we're getting a better rate from this other processor now. We're going to move this volume. You don't have to do anything with your sub-merchants. No recontracting. No, you just basically, you've decided to change providers behind the scenes, and it works the same way for that merchant. So that's a huge benefit when you get to these higher volumes. Now you have that flexibility. You can add processors, change processors. You don't have to change their agreement. the merchant agreements, which is the pain point. So better to make this change before you get to this volume and have 1,600 merchants, because if you keep waiting, now you're going to be at 3,000 sub merchants to recontract, and then 4,000 sub merchants to recontract, right? It only gets harder to make the change if you don't have that ownership and control. It only gets harder as you get bigger. So something to keep in mind. Now, with all of that, you know, it is clear to me that it makes sense for almost anyone. If you're over, you know, $50, $100 million in GPV and gross processing volume, it makes sense to be a Payfac for all the reasons I just covered. There are so many myths out there that are not true. I think it's just a no-brainer. There are some other models that have emerged, though, that I wanted to just touch on here. In this Harvey Ball slide, kind of like those consumer reports, you know, where you're looking at the washing machine ratings or a new car maybe you want to buy or used car. We put this together to outline kind of the pros and cons and what's good or bad about some of these alternative models that support this concept of embedded payments. So the first one on the left, referral model, that we can all agree we need to get away from. The slow boarding, no visibility, no ownership, no control, maybe you get a little rev share, but it's piddly, bad merchant support, you know, it's disjointed. Everybody can agree, like referral model is gone. You don't want to do that anymore. It's easy, maybe you got some easy cash from it, but it's just not going to be good for your business overall. Then on the right side is build your own full payment facilitator. That's how the initial payment facilitators in the market did this, right? There was no Infinicep back then a few years ago. And so they had to build everything themselves. They got all these benefits, but they had to integrate to the processor themselves directly. That can be very painful. That can be a lot of work. They get all the benefits. That's why they're in a great position. That's why it's the model to be part of. But they had to build everything themselves. So let's focus on these four middle ones. Full payment facilitator. So second to the right, full payment facilitator client operates. This is what Infinicep was for. This is why we came to market. Why we built the platform we did is so we could offer our clients all these benefits. They could get all the benefits of being a Payfac and not have to do the work of integrating to a processor. And they own the data. They have complete control of this underwriting and merchant support. They get the full top line revenue. They are in their best place by being a full payment facilitator. Now, what we heard from people though is they're new to payments. They're vertical software companies, right? They're used to doing whatever software for their business customers. They weren't into payments. And so we built a program that we call managed services, where we can operate the program on a temporary or full-time basis, but kind of like training wheels for the Payfac program. You still have that instant onboarding. You own all the data. You have the merchant agreement in your name, and you're basically just outsourcing the operations to the Infinicep team, where our team of expert underwriters will follow your policies and procedures, and it creates a really good outcome where you can ease into your knowledge and understanding of how this all works by watching over our shoulder and learning beside us while we can get you up and running quickly. So that's what we call, that's the right side middle option, full payment facilitator Infinicep operates. We thought that it's been very popular. It's a good way to get into the Payfac model without having to hire a team at first, without having to have all that knowledge, and then you can learn from us and take it over when you're ready. Take off those training wheels when you're ready. So now what happened is there were some of the big providers, and the two that come to mind are Stripe and Adyen. They have what some people would call Payfac Lite, but what they did really is they're offering Payfac-like capabilities where you get instant onboarding, You control you have the revenue, you take the liability, so you're managing the risk, and you support the merchants. So it's like, wow, those are great. Those are a lot of the big benefits of being a Payfac, and they're delivering those things. Now, the only downside is they make you build all the tools. So you have to build that merchant application. You have to build underwriting capabilities. Because remember, they are only going to do underwriting that meets compliance. They're going to check OFAC, they're going to check match. They're not going to do business risk underwriting. They're not going to look for bankruptcies from that merchant. They're not going to look at bad business practices and their credit. They're going to just do what they have to do to be compliant and make sure they're not onboarding some international terrorist or somebody that's on that OFAC list, right? So you still need to do underwriting. You still need to build a sub-merchant portal to show the merchants what their business was, what their chargebacks were, what their deposits are going to be every day. You have to build all of those things. And so this is an interesting model. I think it solves for some needs out there, and you actually can still use Infinicep for this because if you don't want to build all those tools, we can plug in and send the board to Adyen, for example, and we're integrated to Adyen for those the transactions, and we then display them all. We add the fees and display them all appropriately for your submerchants, branded in a portal that looks like your portal. So all of that has kind of emerged as not quite a Payfac, but pretty close. The main thing is you're taking the liability, and so you get a good rate because you're taking the risk. You know your clients, but I'll tell you, and I'll tell everyone this: if you're taking liability, you better have the tools to manage your risk. You better know who you're onboarding, and you better be able to monitor their transactions to look for things that are not aligned with that profile. So this is a responsibility, but it's an interesting new model. Now, the closest to the referral model is what's called Payfac Lite, also called Managed Payfac, or Payfac as a Service. There are a whole bunch of different names out there. They're marketing names. And what they do is they provide a couple of the benefits of a full Payfac, which is better than the referral model, but you're still left with a lot of the problems of the referral model. So first of all, they'll have a nice branded fast boarding experience. They'll customize it for you, and you can instantly onboard merchants. So that's great. That was one of the biggest pain points of the referral model, right? But you don't own that merchant. The merchant agreement is in the payments company's name, not your name. You don't have any control over them. And the revenue may be a little bit better than the referral model because usually these companies that can provide a Payfac Lite program have a more modern infrastructure. And so they can pass on some better revenue share to you than the legacy providers. Merchant support, we kind of see it depends on the provider. Best cases, of course, is if they let you support your merchants, because you're going to support your merchants better than anyone else. So best is if they give you the tools to provide that customer support. So that's the whole spectrum of what we see as embedded payments. Except for the end referral model, we don't consider that embedded payments because that's disjointed, and that's integrated payments, right? It's part of your software, but it's not handling the entire experience. The rest of these really are taking into consideration what we call embedded payments because it's a better merchant experience overall. And we want to help you decide what's the best one for you to start with and make sure that you have the ability to grow and graduate to a full payment facilitator where you get all the benefits. So this final thing that wasn't on that Harvey ball chart there is liability, and that's important enough for its own slide. These first two options here, the referral model and PF Lite, there's no liability. And you think liability is a bad word, so that's good, right? You don't want liability. Well, actually, you're probably overpaying for someone else to take the liability. That's the problem with it. Is liability to me means ownership. It means you're responsible. It means, you will handle it. In any of these other models, like the chargebacks are passed to the merchant automatically. They're netted on their deposits. You have to just worry really about if that merchant's going to go out of business or was fraudulent from the beginning. So it actually could be good for high risk businesses. If you're working in an industry that is high risk, that might not be a bad idea to stay on a referral model or do PF Lite. But for just about everyone else, it causes more headaches than it's worth, because the liability is with the PF Lite provider. It's with that company, that payment company. And so what are they going to do? They're going to overreact when there's anything that looks like it's a problem. They can hold reserves, which merchants hate. And so it's part of your program, your software, right? So they're not going to be happy with you about that. They get declined, which causes a huge problem for your merchant, for your customer. And we hear a lot about companies that will just close accounts. They see some odd transaction behavior. They think it's fraud. They have some kind of AI going on in the background, and they say, no, we don't want to take the risk on that, so we're going to shut them off. Well, that becomes your big customer service headache, because that customer can't take payments anymore. So all these options on the right are, in my opinion, a better approach. You get more revenue by taking liability. You can manage the risk with the right tools and the right policies and procedures, and you can claim that full transaction fee as your top line revenue. So hope that overview helped of kind of what's out there, the spectrum of options and some of the pros and cons in our little Harvey Ball analysis. Now, if you're doing embedded payments, that is actually what we consider the foundation for embedded finance. More and more software companies are offering more finance solutions for their clients, like financing, loans, working capital, disbursements, card issuing, digital banking, insurance. That's another one actually that we should add to this list. That's becoming more popular. There are a lot of additional services and benefits you can provide your clients, but you have to be able to do these basic things that I outlined about being a Payfac first. You have to be able to manage your risk. You have to be able to underwrite and onboard your clients to a payments program. That same information that you collect, their social security, their tax ID, their ownership, the beneficial ownership information, that information is the same that's used to assess risk of offering these other services to them. And if you're not controlling that, and you're not collecting it, and you're not managing that data, you're not going to be in a position to offer the next thing in embedded finance. So own the merchant application, own the contract, own those underwriting decisions, and if you know your clients and you're monitoring their transactions, their financials, you're doing the funding, you're depositing their payment money into their bank account that's coming from you. And so that is really just a foundation to start and to offer these things that are coming up in the future that are going to be more competitive requirement at some point too. So, that reminds me of another myth that some people were saying, is that as a Payfac, you need to have a money transmitter license, which is a huge expense and huge pain. And that's not true. That's another myth we should add to that slide. There is a proven method that all of our clients use with the sponsor bank. You set up an FBO account with the bank, and the bank is the one that's actually moving the money from the card brands that deposit the funds from the credit and debit card transactions. And they use the funding instructions from the Infinicep platform to then move the money. And since you don't touch the money, you don't need a money transmitter license. You're not in scope for that. So if you hear that as an objection of why you shouldn't be a payment facilitator, that's completely wrong. It's not required to have a money transmitter license. Because there's a way to have that full control still, to own the revenue, control the funding and what gets funded just by sending the instructions to the bank and not touching the actual money. And if that, I hope that was a good overview, an outline of the costs, of the benefits. And what we like to do at Infinicep is be your Sherpa on this journey to help you make sure you're choosing the right model, make sure that you have the flexibility for the future when you want to grow and graduate to a full payment facilitator. And so this is our outline of what we call the journey to a software-led payment solution. We help our clients go through the business solutioning, making sure that the financial model makes sense, the ROI. We will talk through the compliance, the risk, the staffing, sales, technical aspects, picking the right gateway and processor. We go through funding flows and our platform demo. There's some optional APIs to integrate to on our platform if you want to control even more of that experience and go from the quick to implement white label solution. If you want it more in your native software platform, you can go to our APIs and pull that data in. Decisioning, we want to help you make this the right decision and figure out the time frames. We've helped people create board presentations and work with their investors because this is a really big strategic deal for your company to become a payment facilitator. And then launch. We have a very experienced implementation team that will do some additional design on the details and the configuration and really customize that for your business and how in the way that you want to offer payments to your clients. And then you are off and running with your own payments program. So please, if anyone is on the line and has questions, I would be glad to answer them. I don't see any chats right now in the little chat box or Q&A. So I'll give you a minute if you want to type anything in. I'd be glad to answer it. Or my contact information is here, and we would be glad to answer any questions you have on another call. We're here to help you make the right decision if payment facilitator is the right approach for you. I don't see anything in the chat or Q&A. So I think at this point we can call it a wrap and enjoy the rest of your week. Thank you for attending, and please don't hesitate to reach out with any other questions to Infinicep.